Joining me now with more on the Fed and markets, Bill Stone is Chief Investment Officer at the Glenview Trust Company. Nancy Tengler is CEO of Laffer Tengler Investments. CNBC.com finance editor Jeff Cox is with us as well. Where to begin? Bill, I'll start with you and go left to right here. How about that? I mean, if Michigan is right about a recession being the inevitable result of this, does it make you rethink how you're positioned here?
Well, not necessarily, because honestly, we went into the year honestly thinking we would get a recession at some point. I'd say we thought you might get it a little bit earlier in the year because, you know, the way some of the numbers were starting to play out at the end of last year. But we really started to accelerate again. The, Atlanta Fed's GDP now is up to expecting about 2.3% here in the first quarter for GDP. So it's not going to, well, almost shortly not going to be here in the first quarter. So I think Michigan's right. If they have to keep pressing on higher rates, you just better expect that eventually they break something and may have to break something. Kashkari talked about the fact that services is a problem. I say it's a problem. It hasn't weakened the way they expected. And that hasn't, that's a big part of what's the sticky part of the inflation. So look for them to keep hiking because eventually it'll probably or will hit payrolls and jobs, and then that will kind of start that, unfortunately, that way, but that'll likely be the only way we get inflation to move in the direction we need it to go.
Right. So in other words, it wouldn't be a surprise to you. And I guess the question is whether it is fully priced in. Your stocks, you still like Berkshire, you like Discovery Financial, you like Medtronic. Nancy, maybe I'll turn to you. Do you think the recession's already priced in?
I don't know, Kelly. I kind of think so. It's been the best telegraphed or the longest telegraphed recession that I remember. So we know, nonetheless, that growth is slowing, and that's informed the way that we've been moving our portfolios, adding to risk. I think Bill's right. I think it comes at some point this year. It's just a question of how deep it will be and whether or not it sustains. We sort of expect kind of shallow, kind of not lasting very long. And therefore, if that's the case, we think that equities probably have priced in what they expect out of earnings. And if you look at the multiple ex-FANG stocks, we're trading at 14.8 times. So there are places where you can make money. We've been adding to technology and consumer discretionary names, as you know, and we're continuing to do that.
Okay, why is that for those sectors, Nancy, or where in particular?
Well, so in technology, we love ServiceNow, Palo Alto Networks. Those are both in our 12 best ideas portfolio. Microsoft, Broadcom, really with a focus on cloud, cyber, of course. And then if you look at the solution to that, or the solution to productivity problems, and productivity improved in the last labor cost report period, you've got to have digital solutions. And so we're seeing old economy companies embracing digital solutions, and we are also invested in those. So think of Chipotle, McDonald's, which are using digitization to their benefit. You could add Starbucks, though we don't own Starbucks any longer.
Yeah.
So I think there's places to go. And if stock pickers market, you and I think probably 2 or 3 years ago talked about Intel, and I just said it's enough already.
Yes.
Well, we did get out, but if you just look at that stock compared to the SOX, that tells you everything you need to know about this market. It matters what you own.